Good morning. This is Howie, and I'm here to help you win with money. Today is Friday, February 19, 2021. This is the last trading day of week number 7. Markets or futures look green, so look like a decent day to recover from yesterday's red day. Really, the big news was yesterday was the Robinhood or the GameStop hearings. So let's talk about what is the order flow and why is it important. Here, it talks about how the hearing will scrutinize how brokers get paid for it, and that's pretty normal, getting paid for order flow. But what's not normal is Robinhood generally makes way more money from order flows than other businesses. Here is some detail of that statement. Robinhood made more than 600 million from payment of order flow, and it goes into the details of how much money they made. And it goes on to show you how this breaks down. So options trades normally get a little bit more money per trade. Non-S&P stocks get a little bit more, and obviously the most S&P stuff have very narrow bid ask, so you get less payment for that. That makes sense. And if you just follow the charts, this makes sense. Same thing here, nothing unusual here. And so this is pretty normal stuff. What's not normal is the amount that they get relative to other companies. And so this is what people are raising an issue with is why would Robinhood get paid more than even the other companies? And I want to go here because this person actually did a really good write-up last year. And it just shows you a real quick sample of how this thing works, the order flow. And remember, the wholesaler is supposed to find you the best price. And it goes on to talk about all this. It gives you an example. Stock A, right? There's a price gap. There's a 10 cents difference. And it talks about what the impact is. And in this particular issue, they do say there's some issues here because of high frequency traders can be front running. They can be front running the trade because they see all the orders coming in before it hits the exchange. And that's why this is really important because those big companies generally will own another company which owns like a high frequency trading firm. So if there's a 10-cent spread, what they can do is buy the stock at $20.01 in this example here, and then flip it to you right closer to the ask price. And so this is an interesting concept. So it talks about here, Robinhood, right, made most of his money from payment from order flow. The fee is 10 times the industry standard. So this is why people are questioning it. Why would it not be on par with the other firms? Why would it be slightly more? So there's some speculation around this area. For instance, if Robinhood traders are not buy and hold investors, they trade more frequently, so you can make more money off of just the fees or the trading, right? Or through this order flow. So that's one piece of it. Another piece is something I'm going to show you through my ETrade account. I'm going to show you something real quick. I went into my executed orders, and you're going to see what the limit price is. If I place a limit order, you're going to see this is the price that I wanted. This is the price that's executed. And you see, this is yesterday's trade. I put in a trade to collect 25 cents. I got 37. If somebody was front running it, they knew I was willing to get this much. And then people can just make all the money, right? All these high frequency traders or your brokerage account or whoever else will make money, drive the price down or right, or up or down, depending on what you're doing. I'm doing an options trade, so a little bit more complex because there's two legs. And then they can just bring the price closer to what I was willing to pay for it, which means somebody else made the difference between the two prices. And I'll show you what I mean. I'll scroll down another one so it's a little bit easier to understand. Here's another one. I'm willing to close this position at $1. I closed it at 99 cents. So that was the best execution price. So my brokerage company didn't charge me $100, they charged me 99. Here's another case. I was trying to close a position. I was willing to pay 50 cents for it. I actually paid 48. Here's another one where I'm buying the a cover call. I was rolling it up. I was willing to collect 22. I got 23. So you see, my brokerage company is constantly giving me the best price, even when I'm doing these limit orders. Here's another one. You see that? This is carparts.com. I put a limit order, executed here. Here's one where this is a limit, but on a stock. I got the price that I wanted. Here's a market order. Market orders don't have best pricing. It's just you pay what you get. But you can see the pattern even in my account. Here's another one where I'm doing a iron condor. You see this? I was opening it up for $131. I got 2 cents more. So here's what I'm going to speculate, and I don't know if this is true. In Robinhood, if you're getting paid more by people who do these trades for you, my guess is there's less and less likely that you're getting the best price. I'll say that again. So because the fee that somebody is paying is coming from somewhere. There's obviously no free lunch anywhere. So in order for these companies who want your orders, if they're paying you more for the orders, I can almost guarantee you that you're not getting the best price, sort of what I show you on my ETrade account. And can I guarantee you that I'm getting the best price? Absolutely not. But ETrade is probably getting less than what the industry standard is, right? And so you have a better process in place where they round robin it or they route it through different broker dealers and stuff like that. There's a lot of other ways to make sure people are still fighting for your business. You don't route it through one place like Citadel. And so there's this issue of speculation that's saying most likely Robinhood traders, whenever you put in a limit order, even if I can get it cheaper for you, 2 cents, 3 cents, whatever it may be, I'm not going to give it to you. I'm going to let you pay your price that you asked for because you will never know. And that's, I think, really the bigger issue because that is not transparent. No one will produce a list of the time that your order will be placed, all the trades that happened, and what was really the best price. You see, I could have got ripped off by 12 cents, and I would have never known because I put in my limit price for this particular price. And generally speaking, I like putting my price a little bit close to the mid, sometimes under the mid, sometimes over the mid. And you see that in all my videos. I just think there's a better competing product out there. Other brokerage companies have been around longer, and I just think there's better products that you have. That's the beauty of freedom of choice. You can pick whichever service or business you want to use. No one is forcing you to use Robinhood or Webull or M1 or Fidelity. You can use whoever you want. But I wanted to give you a quick overview. In any case, don't forget to hit the like, subscribe, give me a thumbs up. Let me know what you think. As always, let's do this together. Let's do this $1 at a time. Have a profitable day. Bye-bye.